Hi, it's Ben Manzo, financial consultant with IG Wealth Management. I wanted to talk today about investment concepts for 2021. And I thought what we would start off by doing would be looking at investing knowledge as well as investing strategies. And what I'm going to do a little differently today is break up this video into two parts just so that we have enough time to cover all the content. So I wanted to start off by looking at guaranteed investment certificates. I'm getting clients and prospects talk to me about, their portfolio of GICs and wanting to earn somewhere between 3 and 4%, or even in some cases higher than 4%. You know, to get that rate of return, you will have to look at other alternatives, plain and simple. But what I wanted to talk to you about today was, understanding the inner workings of a GIC and how banks cover their costs and enlarge their profits by charging a spread on the money that you invest into a GIC. And so in some cases, in fact, most cases, that spread, that difference is quite significant. And so the example below talks about 100,000 GIC where a bank earns about 3.45 when lending the money out as a mortgage, when in fact they're only paying the interest of 0.6. So you can see quite a significant difference. We talk about fallacy of forecast. We have to look at how indices, in this case the S&P 500, how there's a difference between what's expected versus what's actually realized. So if you look at the chart below, it looks at what the expected realized return differential is. And so the blue line represents what the expected rate of return is based upon what the financial analysts are looking at when they look at, for instance, a 12-month forward price target. And the red dot recognizes what's realized. So in 2002, you can see here what was expected was plus 14%. In fact, what was realized was minus 22%. In 2008, plus 16%, and what was the actual return was actually minus 37%. We saw a reversal of fortune in 2013, where the expected return was plus 2%. However, the markets came back strong at plus 32%. So what do we take from this? Essentially, that you don't want to take too much stake from what a financial expert is saying year in and year out about what the expected returns are looking like. And so, over the short term, we just can't predict that. However, what we can predict is over the long term, we know that we're going to see a positive rate of return. And that really, that magnitude of return is really dependent upon your overall risk profile and risk tolerance. When we look at interest rates, and right now we see that interest rates are rising, we have to look at the impact it has not only on bonds, but on our overall portfolio. So if interest rates were to rise by 1%, and if we looked at a bond that had a maturity of 5 years, what we call duration, we would see that the price of the bond would drop by about 5%. And so when you look at a portfolio of bonds, you also have to look at, short-term versus long-term. We know that long-term bonds are less sensitive to interest rate swings. However, you also want to include, equities into your portfolio so that you can have that complete diversification. When we look at investing strategies, it's so important to start to invest early. However, we know that everyone's situation is different, and sometimes that can't happen. But what I wanted to illustrate is the difference between starting early versus, waiting. And so if we look at two individuals, Edward at the bottom, Edward Eager, we'll call him, and Larry Linger, you can see Edward starts at the age of 22 and over 14 years of investing at about 3,000 annually. You can see, assuming a rate of return of 5.5%, that gross is about 290,000. Larry, on the other hand, starts at 41, invests over that same 14-year period, 3,000 annually at a rate of return of 5.5%. His growth is about 86, almost 87,000. So you can see quite a significant difference. So the earlier you start saving requires fewer years of savings, making it easier for you to achieve your retirement goals. And lastly, dollar cost averaging. So this is very effective, and oftentimes it's referred to as paying yourself first. And so the objective here is to, on a monthly basis, put money into your savings. And so you are forcing yourself to save, and you are buying your investments at the high point, at the high price point, and you're buying investments at the low price point. So essentially, what you are doing is you're averaging returns over time. So what this ends up doing is it basically lowers your unit cost, which will then magnify your growth in the portfolio. So very important. So please do reach out to me if you'd like some further clarity on what was mentioned in today's video. If you have an advisor but you want a second opinion, then let's have that discussion. If you have a plan and you're not sure whether or not these concepts are incorporated, then please reach out to me. And finally, if you don't have a plan, then let's make it a priority to put one in place for you. Thank you so much for your time. Please also follow me or reach out to me through Facebook, LinkedIn, Twitter, Instagram, YouTube. Be more than happy to help out. Thank you so much. Have yourself a great day. Bye-bye.